Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Thursday, January 18, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. So we had a relatively quiet day today. There were some things under the hood that we're going to talk about in terms of what I believe to be tip-offs for a directional move leading into tomorrow and possibly into next week. But all in all, after the big up day we had yesterday, following the big down day we had the day before, today was what we call a do-nothing day. It was mainly a pause in the market, and the market was flat for the most part. The S&P 500 finished down 4.5 points, but that's close to the flat line. The Dow finished down 97 points, and the Nasdaq Composite was also flat, down about 2 points. But as you know, there's always clues in the market. If there's going to be a move in the market, there's generally a clue somewhere to be found, whether it's in the S&P itself or another market that gives us a tip-off because it can act as a leading indicator. So we can't tell anything from the daily chart of the S&P 500 or the SPY as you're looking at here because it's basically just a sideways day in the upper range near the all-time highs. We can't tell anything from that. Of course, the market can just shoot higher from here. I think that's unlikely, and one of the reasons I think it's unlikely is this afternoon's activity and also the activity in the IWM, which we'll get to in a few minutes. As you know, it's my favorite leading market indicator. What we're looking at here is an hourly chart of the SPY, which of course is the proxy for the S&P 500. And what I notice here on the hourly chart, and I think this is important, is that we have a high made the other day, we have a lower high made yesterday, and then today, another attempt and another yet lower high. All very marginal lower highs, but lower highs nonetheless. Generally speaking, when we get 3 lower highs, and this can apply to a short-term chart, an hourly chart, it can apply to a daily chart, or even a longer-term weekly or monthly chart. When we generally get 3 lower highs, that tells me more often than not, lower prices are coming. However, what we do have to notice is we're still above all the moving averages, even on the hourly chart. So we are at the 20-period moving average, and on the hourly chart, the 20-period moving average isn't all that important because we're basically been back and forth through it a number of times of late, so that diminishes the importance of the 20-period moving average. But I do take notice of the lower highs. I think that has some importance. So let's move along and see what else we can find if we see any other evidence of other markets giving us an indication that we can sink our teeth into that might give us a directional move in the short term. How about the IWM? So the IWM was down almost 1% today, where the SPY, or the S&P 500, was down about 1/3 of, actually less than that. The S&P 500 was down 16 basis points, or less than 0.2%. So when you look at the IWM, if you believe that it's a market leading indicator and it was down 1%, is the IWM trying to tell us something? Is it trying to tell us it's leading the market in the downward direction? Well, so what do we have? We're above all the moving averages. That's bullish on all the charts. However, in the S&P 500 on the short-term chart, we have lower highs, and on the IWM, we have a down day far in excess of what the S&P 500 was down. Generally speaking, the IWM is going to lead the market in either direction, either on the upside or the downside. We did have that reversal day the other day in the IWM, and now we're going sideways. And generally, when we go sideways after a reversal day, that's the market's way of telling us it's setting up, building energy to go lower. What do we have on the hourly chart? Well, it's pretty clear to those of you that have either taken my course or have heard me discuss this many times. We have a bearish pattern. We have a down move. We have a sideways wedge pattern in the sideways to upward direction. This will generally promote another move in the downward direction. And towards the end of the day today, that seemed to have started to unfold as far as I can tell. We're below the 20-period moving average, and we close this 60-minute candle below the 50-period moving average. That can't be a sign of positive behavior. However, I do believe it is a sign of negative market behavior. How about the VIX? We've been looking at the VIX of late. Where are we on the VIX? We're at near-term highs. I'm not suggesting we're going to explode to new all-time highs or anything like that in the VIX. What I am suggesting is that the market, generally speaking, the stock market, is overbought. We've been discussing this for a long, long time. It's overbought, and it needs to work off some of the overbought condition, come back toward home base or the 20-period moving average. That's normal garden variety market behavior. So what are we getting from the VIX? We're getting an indication as the VIX rises and has been rising for the last 3 or 4 days, we're getting an indication that there's fear out there in the market. There are institutions / retail investors / whoever it is, it doesn't matter, buying protection, thinking the market is coming down. Now, the market doesn't have to collapse, doesn't have to come down 5 or 10% to work off the overbought condition. It just needs to come down a little bit to reset itself. That would give it enough breathing room in order to reset itself to make another leg higher, which I think is entirely possible. I just think it's completely normal for the market to work off some of the overbought condition, and now is as good a time of any. It doesn't have to be a long-term correction. It could last for a few days. That's all I think is necessary in order for the market to just come back down to planet Earth, at least from a temporary perspective. So in terms of the VIX is telling us that the market is likely has lower prices ahead. Looking over at the transports, nothing doing in the transports. It seems to be putting in a bearish wedge pattern. We had the reversal day the other day. We've had a couple of very quiet sideways days in the transports. This is the market's way of telling us it's putting in a bearish pattern. Likely the next major move is to the downside. But again, there's a lot of white space. There's a lot of runway here for the transports to come down a little bit, work off the overbought condition as other markets indicate, and still remain in a very strong uptrend over the longer term. I think that's entirely possible. I think it's entirely probable. So all in all, in a nutshell, not a lot has changed from yesterday. I'm just giving you my take on what I believe the highest probability is for the next major move in the market. Major move doesn't have to be hundreds of points in the S&P. I'm just talking about over the next few days. Are we going to go higher or are we going to go lower? The probabilities, as far as I can see on the charts, have us going lower. And by the way, back to the SPY for a second. Let's say we did go lower and we came down 20 or 30 handles in the S&P 500. That puts us right in this neighborhood, 275, 276 in the SPY. That still remains in a very, very bullish uptrend. And if we chopped around for a few days in doing that, even came down a little bit lower, it still doesn't impact the bullish uptrend. But what it does do is it eats time off the clock and lets home base or the 20-period moving average come up toward price and lets price come back toward the 20-period moving average. And there you have working off the overbought condition. So I don't think there's going to be any severe damage done to the charts. I just think we're due for a couple of additional down days in the market. Maybe it gets tied to the potential government shutdown that's being discussed in the news. You know, the politicians are always jockeying for position, and they always try and scare, one side try and scares the other side. If we have a government shutdown, government employees aren't going to get paid, this isn't going to happen, nobody's going to get their Social Security checks. It's all bunk, it's all nonsense. None of that stuff ever happens. What they do is they shut down a few parks, they put some ropes around some government-managed monuments, and nothing really ever happens. All the government employees, while they may get a few days off if we actually go down that road, they always get their back pay. Nobody wants people to lose pay. It's not their fault. It's the politicians' fault for not being able to balance a budget, and that's really the bottom line. The proposed government shutdown or the government shutdown scare is really due to the fact that they're not able to come to an agreement. The Democrats and the Republicans, they can't agree on one thing or the other. They're tying an extension of the debt ceiling in with this DACA deal, and it's nothing other than the politicians' inability to show leadership on the behalf of the American people. It's nothing more, nothing less. The rest of it is just soap opera nonsense. That's at least my 2 cents anyway. How about gold? So gold continues to come down a little bit farther. The 1338 to 1340 seemed to be the resistance point we discussed for a while. It actually went up to 1345 even and then backed off from there. I still think there's probably lower prices coming in gold. There's no damage done to the uptrend, at least the short-term uptrend as we see it here will probably come down farther. If we did come down and started getting below the moving averages, for example, and the real line in the sand is going to be if we get below this level here, these pivot highs, that's going to be an eye-opener for me. And if we start closing daily below this level, then I think gold could be in some trouble and we'll assess it at the time. But right now, there's no damage done on the chart. This is working off, again, just like the stock market, an overbought condition. It's normal garden variety market behavior. It's down $18 from the high the other day. It's not a big deal one way or the other. And by the way, it wasn't unexpected at all. Crude oil continues to go sideways in this upper range, obviously still in a very bullish uptrend. Just like the other markets, same story. We'll work off some of the overbought condition, not uncommon garden variety market behavior. Might come down a little more. It wouldn't be unexpected. Look how far we are from the 20-period moving average or home base. It's likely that we either come down or go sideways and let that moving average come up to price, let price come down towards that moving average. But all in all, this is in an uptrend and higher prices over the longer term are likely. And longer term, I don't mean months or years, I mean weeks to months. So I think we have higher to go in crude oil, but over the next several days, I wouldn't be surprised to see it at minimum of go sideways or come down a little bit toward the 20-period moving average. In fact, $62 would be really, really good support right in this zone right here. If we came down to 62, the 20-period moving average would have moved slightly up towards that number, and you will find a pretty good level, even if we get down there. I'm not sure we will. I'm just saying if we got down to the 62 area, you will find a pretty decent level of support in that zone. And with that, folks, I'm going to keep it relatively short tonight. It's everything that I really intended to discuss tonight, so we'll give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.